Why is the CCI indicator so strange? Some people use it to find overbought and oversold zones, and some use it to find direction of a new trend. CCI is one of the popular and best indicator out there. It can even increase the win rate of your strategy if you use it properly. But that's the problem. There are two different trading strategies based on this one indicator. When Donald Lambert created the CCI indicator in 1980, he used it to find strong trends in the commodity market. Hence the name, Commodity Channel Index. But since the creation of the CCI indicator, market has changed. Traders have adapted this indicator to use on all kinds of markets and all time frames. Now, there are two kinds of traders that use the CCI indicator in very different ways. Some still use it to find the strong trend, and some use it to find the reversals. In this video, we are going to take a look at both of these methods. As always, I will also test the CCI indicator 100 times to find its real win rate and to make sure it works. But I will do it in a separate video. Subscribe to see it. I have already tested MACD, RSI, and other indicators 100 times to find their real win rate. Check those videos out if you want. After all, you don't want to risk your money on a strategy that doesn't even work. This is how the CCI indicator looks like. On first look, it looks like the RSI indicator, but it is very different. On TradingView, the CCI indicator will come with an orange line, called the CCI line, and two horizontal lines, called the upper band and the lower band. The two trading strategy based on this indicator are really simple. Let's start with the first method. This is the method that Donald Lambert, the creator of this indicator, used. When the CCI line crosses above the positive 100 line, in other words, the upper band, it can indicate the start of a strong uptrend. And if the CCI line crosses below the negative 100 line, in other words, the lower band, it can indicate the start of a strong downtrend. In simple words, CCI line crossing above the upper band is a buy signal, and CCI line crossing below the lower band is a sell signal. Here's an example. As you can see, when the CCI went above the upper line, the market gained momentum and a strong uptrend took place. Similarly, when the CCI line crossed below the lower band, the market started a strong downtrend. You can enter trades as soon as the CCI crosses above or below the bands. But you will get a lot of false signals if you use the CCI indicator only. Use it with something else. This method is best used in a trending market. And if you have been following this channel for a while, you know, to find the direction of the long-term trend, we use the 200 moving average. If price is above the moving average, we will only look to buy. This will help us avoid false sell signals. Similarly, if price is below the 200 moving average, we will only take sell signals. This will help us avoid false buy signals given by the CCI indicator. So our modified CCI trend trading strategy goes something like this. We will buy when CCI crosses above the upper band and price is still above the 200 EMA. And we will sell when CCI crosses below the lower band and price is still below the 200 moving average. Always remember, the risk to reward ratio and win rate are inversely proportional to each other. In other words, if you increase the risk to reward ratio, your win rate will decrease. Because price will have to make a big move to reach that profit target. And that doesn't happen every time. Similarly, if you decrease the risk to reward ratio and set the profit target very close to your entry, your win rate will increase. Because price will have an easier time reaching the profit target. Also, don't trade blindly. You should backtest any strategy before risking your money with it. I will test this CCI method 100 times in my next video to find its win rate and to make sure it works. Subscribe to see it. Now let's talk about the second method. The CCI trading method that many people use. When the CCI line crosses below the upper band, the market was considered to be overbought and we should look to sell. Similarly, when the CCI line crosses above the lower band, the market was considered to be oversold, and we should look to buy. This method is very similar to the RSI trading strategy. We can even use the 200 moving average to avoid false signals. If price is above the moving average, we will only take buy signals given by the CCI indicator. Similarly, if price is below the 200 EMA, we will completely ignore the buy signals given by the CCI. Here's an example: the price was above the EMA, and CCI was crossing above the lower band, the market went up. Here's a sell setup: the price was below the moving average, and CCI was crossing below the upper band, the market went down. Here's a tip. To increase the win rate of this strategy, and to avoid false signals, only take entry signals that are near the moving average, or near the support and resistance lines. Furthermore, you can even use multiple time frames to find major supports and resistances. Switch to a higher time frame can also help you identify the major trend direction. To increase the win rate of the CCI strategy even more, you can use the MACD indicator. We know the MACD trading strategy has a really good win rate, since we tested it 100 times. In the MACD strategy, we buy when we see a crossover below the zero line of the histogram, and sell when we see a crossover above the zero line. We can combine this strategy with the CCI indicator. This will help us avoid false signals generated by the CCI indicator. Here's an example. The price is above the 200 moving average, so we are only looking to buy. But without the MACD indicator, the CCI is giving a buy signal, right here. As you can see, it was a false signal. Now, if you add the MACD strategy to this, we can see, the MACD was not showing a buy signal. We could have easily avoided this false signal by using the MACD indicator. The real buy signal was right here, when CCI was crossing above the lower band again, and MACD was also showing a crossover. As you can see, when both of them were showing the buy signal, the market went up. Here's a downtrend example. The price is below the 200 moving average, so we are only looking to sell. But without the MACD indicator, the CCI is giving a sell signal, right here. As you can see, it was a false signal. Now, if you add the MACD strategy to this, we can see, the MACD was not showing a sell signal. Again, we could have easily avoided this false signal by using the MACD indicator. The real sell signal was right here, when CCI was crossing below the upper band, and MACD was also showing a crossover. When both of them were showing the sell signal, the market went down. Like the video if you liked it. And subscribe for more trading videos. Don't forget to ring that notification bell as well. Thanks for watching.